Hey, what's going on, everybody? It is Aaron Trevino here, and we have a terrific guest. We have Joel from St. Louis, Missouri. How you doing, Joel?
I'm doing great. I'm pumped to be on the podcast.
Yeah, absolutely. I know it's been in the works for a little bit, so it's great to see you, and it's great to have you on.
Yeah, pleasure to be on.
Yeah, so for those of us who don't know much about you, Joel, would you introduce yourself?
Yeah, so right now I am doing residential real estate investing, and not for too long now. I graduated back in 2015 from St. Louis University. Got into it as a partner, and just my love for real estate, specifically residential investing, just grew and grew until I decided to start my own firm about a year back now. Feels like 2 years. And so, been running strong with that, and that's where we are today.
Okay, fair enough. So, you've been out working for a few years now, and that's a great trajectory to have, kind of where you started to where you are now.
Yeah, I learned a lot from the guys that I started with. So it was a tier two group. I got out and I didn't go right into real estate. I was like most people, didn't really know what I wanted to do, and like even more people, didn't end up in the industry or profession that my degree would have specialized in. So I was pre-law at SLU and just knew that I liked to negotiate, I liked to debate, and that was about it. And I knew that I wanted to own my own business one day, but that was about it. And so kind of bounced around from really marketing firm to marketing firm, or sales jobs after college, and then eventually landed at like a tier two. Wouldn't classify them as a mom and pop, but some sophisticated guys in the rehabbing business that wanted to transition into wholesale. And so they're essentially starting from scratch, that department, and didn't have the um, bandwidth that they needed to really do, not only do it right, but do it at the volume that they wanted to do it. So that's where they brought me in, because I had some experience in the corporate world per se with building teams at that point, and that's kind of where we found the synergy.
Yeah, absolutely. So when you had talked about was it tiers was the word you said?
Yeah, tier. So in my mind, this is how I classify investment groups. Tier one, tier two, tier three, or tier one being the institutional grade funds and the hedge funds, and the Zillows of the world that are just gobbling up properties now, and also in multiple different markets. And so and then tier two is not your mom and pop, because they've gone above beyond that. They're more sophisticated now, and so for instance, the group that I was buying for, that I consider tier two, they did 200 deals, or we did together, our last year, which was 2019. So in 2019, our last year together, was when we did that many deals. And a mom and pop group like myself now, for instance, we did 11 deals last year on my own. So um, yeah, and then the funds that I was buying for the tier one group, we were buying 30 to 40 properties a month for those guys. So again, a whole other level with those guys.
Yeah, yeah, absolutely. It kind of seems like all the pieces have kind of fallen together, from the time you were pre-law to, kind of getting your bearings to getting experience and now to where you are now.
Yeah, it's the classic case of one thing led to another. There's no way, if you would have asked me 4 or 5 years ago now what I've been doing now, that I knew that I'd be doing something, just not, I would have no idea it'd be this. Um, and so it really was just one thing led to another, and the more I knew, and the more I understood the business, and specifically the different sectors in our niche, I kind of just eventually landed in a spot that I think I'm the most passionate about. I wasn't, although wholesaling is exciting and it's fast money. It's they're smaller pops, and it's transactional in a lot of ways, but it's fun. It just wasn't what I wanted to do long term, and I always thought if I should find out what I want to do long term so I can start doing it as quickly as possible. So as soon as another opportunity presented itself, and it felt like it was a better fit, even by 5%, 10%. I jumped on it.
Yeah, the way you phrased that was great as well. Just trying to hone in on that and find out what you want to do and jumping on it early.
Yeah, yeah. I mean, maybe I'm doing it wrong, maybe not, but it feels right at this point, and it's a lot of fun. So I guess we'll see.
Okay, very good. So just if you could, just in a short sentence, what do you do? Like in one sentence.
Yep, we acquire residential real estate properties between 1 to 4 doors and hold them for 7 to 10 years.
Okay, fair enough. So is there a reason that you're looking at the numbers between 1 and 4?
Yeah, it comes to, at first that was all I knew. So at the firm I got my legs with, so to speak, that tier 2 firm, we were only doing ones and twos, single families or two families, and that was it. And then eventually we got into some other asset classes. My last year there with them, they bought a triple net Dollar General, or working on acquiring a triple net Dollar General out in Indianapolis, completely different market. And so we started dabbling in some other asset classes, but for the most part, the bread and butter there was ones and twos. So that's what I knew, got into fours, and then ran out of money like everybody does. And so needed to raise capital to continue to do more deals. And so the investors knew that that's what I knew best. And although I wanted to go out and buy, a couple 20 units or 40 or 50 units, they said, that's great, but we're not going to test the waters with our money. So, go be successful with someone else's money, and then show us a track record like you did with ones, twos, and fours. And at that point, maybe we'll talk about it. But for now, let's buy those.
Yeah, absolutely. And if you could, maybe reverting back a bit to that Dollar General in Indianapolis, you used the term triple net. Could you explain what that means?
Yeah, so triple net, to the best of my knowledge, is when the tenant not only pays for, not only their expenses and their utilities, but above and beyond that, common area maintenance and even taxes and insurance, and like any lease, everything's negotiable. But the overarching theme is it's a hands-off investment when you buy them. And yeah, so that's what they wanted to start adding to the portfolio to, I guess, further diversify it. And so, yeah, I don't know how it turned out or how it changed the overall portfolio return, because they were only in the process of acquiring it when I was there. But yeah, it's a pretty interesting pivot.
Yeah, I would imagine it's an entirely different market too, as well, right?
Yeah, Indianapolis had a lot of the strong driving, economic drivers that St. Louis has and also lacks in some areas, but they're similar in that regard. But yeah, it's I think it's 4 hours away, or no, I might be cutting it short there, but it's quite the drive. And then it's a completely different town, and they didn't know anybody in that. I guess, to the best of my knowledge, didn't know anybody over there except for a couple guys that were in a national mastermind with them. And so, they really relied on their understanding of the market, on top of the due diligence and research they did. And because those guys are actually the boots on the ground operators. And so they partnered with those guys, so that if the toilet clogged at midnight, they weren't driving, out from St. Louis to take care of it. So those guys are really the boots on the ground out there.
Yeah, absolutely understood. So for those of us who aren't familiar with the St. Louis market, could you kind of describe the city and kind of maybe what the market or the economy is like?
Yeah, St. Louis is one of the cheapest places to buy real estate in all of the Midwest, and a lot of people love it for that very reason. And the couple of the hedge funds that I was buying for here, out here, loved it for the same reasons as well. And so a lot of people talk about, the 1% rule or the 2% rule, right? And so out here you're looking at, achieving that 2% pretty easily, and then sometimes even going above and beyond that. And so obviously investors love that. And so that's St. Louis, cheap real estate. it's also not a city known for development, and it's not going to get the next Disneyland or Disney World, and it's not going to be on that list. But it's just a steady Freddie market. Some people might call it stagnant, but we don't see a lot of dips unless it's a huge national disaster like '08. But it's a pretty steady market, and it's a safe bet.
Yeah, absolutely. And you touched on something interesting there as well, was a 1 to 2% rule. Could you kind of elaborate more on what that means?
Yeah, so how we calculate it is 1 month's gross rent over your all-in cost. And so the golden rule at the very first firm I worked with was, if I want to be in, one of the partners at the firm loved D, C class real estate. The other partner at the firm loved higher class, A class, B class real estate. And so two different interests when it came to their personal portfolios. And so the partner that liked the lower class real estate assets always said, if I can be all in for 35,000 and I get about $750 in rent a month, then I'll be happy, and we can buy those all day long. And so that would be about 2.1%. And so you take 1 month's rent, $750 gross rent, you take it over your all in, which includes your construction. So it's going to be your purchase plus construction. If you want to include holding cost and closing cost and some of those other things that are going to be fixed expenses for the most part. But we would just do purchase plus construction to make it easy for our guys to go out there and buy properties. And then they would take 1 month's rent over that number. And if it hit 2%, it was usually a green light.
Okay, so you're just looking to hit 2% and beyond that, or are you trying to stay within a certain range?
We just had our buy box threshold. So our buy box criteria, had some thresholds that had to be hit before we, would truly consider acquiring a property. And so, that's one ROI metric. We looked at a certain percentage of equity capture that, we had to hit or go above in order for us to seriously consider the deal, and a minimum net profit that it would produce for the company. So we had looked at a few different buy box metrics, and yeah, that was one of them.
Yeah, absolutely. And you touched on something earlier as well, saying that you look at properties 1 to 4 units, and then you also hold them for 7 to 10 years, right?
Yeah, most of them are long-term holds. We do fix and flips as well, just for cash infusions, for operational reasons. But for operating reasons, that's mostly what we'll do. Those is the buy and holds. And so we hold it for long term because our business model is we are doing a majority of the repairs and renovations on the front end. And then, we're holding it during the hold period where the systems are going to be in good shape. So, no repair or CapEx there. And, the flooring and paint and kitchen cabinets and bathroom models are generally going to last a few tenants. Hopefully they're all there for 2-3 years. And, we're not going to have a ton of CapEx every time we do a unit turn. And so for us to do that kind of work on the front end, it makes sense to hold it for a while until it gets to that next period in the property's life cycle where it's going to start requiring some more capital.
Okay, now is that what you meant by unit turn?
Yeah, so the unit turn is when the tenant that was living there is now moving out. And so we call it turning the units, or making them, getting them rent ready, or doing a make ready. And if we do all the work on the front end and we screen the tenants really, well on the back end, then if we do experience a unit turn where a tenant does turn over, then hopefully they took care of the place, and we ask for a large enough security deposit. That way, any repairs that do have to be done, it's no capital out of our pocket. It's just time, and that allows us to continue to lease it up in cash flow.
Yeah, absolutely. And you'd also use another term as well, was cash infusion as well. Could you kind of describe what that means in that context?
Rentals, don't make you rich right off the bat. The guys that own thousands and thousands of doors, well, they're plenty rich now, but when they were buying their first, when they were first growing their portfolio, I imagine that they were, tight on cash flow, much like my firm right now. So, when you're out, rentals are a lot of capital outlay, and then you put a tenant in there, and then boom, you're making $750, right? And so you might have, on the last one that we did, well, the last four that we did that we're currently refinancing, we bought them all for about 50, and we put about 30 into each one, and they're all worth about 180, 190. So we got a ton of equity in them, and so we're equity rich, and we look good on an asset sheet, and like a personal financial statement, a PFS, but we don't. If you looked at our bank account statements, it's not going to be, showing a bunch of zeros because all of our net worth currently is locked up in equity. And so, until we sell those properties and actualize the profits, it's pretty, tight cash flow wise. And so we felt that for about when I say we, myself and my capital, and my investors, my capital partners, we felt that, for the first 6 months, didn't really, pinpoint it. A lot of things were moving, fast. We were hiring people, growing, and then we took a long, hard look at our accounting software and realized, why it felt like that. And so we decided to start doing some flips, because up till that point we were just turning them all away, and so now we do flips here and there, so that 30, 40, 50K gets infused into the business. So if we want to go out and buy more properties and accrue more holding costs and utilities and insurance, we have the capital there to do so.
Yeah, absolutely. That sounds crucial, especially because, like you were saying, you guys look great on paper, but a lot of that money was tied up in equity, as opposed to you having that liquid cash that you could use.
Yeah, exactly. And it's nice seeing your personal financial statement grow, but when you need money, it can't help you. It can't help you any.
Yep, absolutely. So what are you looking for right now? Are you mostly looking strictly in the St. Louis market, or are you looking in other markets as well, or what are you kind of looking at?
Yeah, so there's a ton of room to grow still in this market. So we're still focusing on growing this market, growing the portfolio solely in this market, and simultaneously kind of looking at other markets. I know Indianapolis pretty well for obvious reasons, but there's other markets like Nashville, Tennessee, or Memphis, Tennessee, sorry, and Little Rock, Arkansas, and there's some other markets that we have our eyes on, just are not to the point where we're really doing a comparative market analysis to decide which market we're going to go into next, because there's so much ground to be covered in St. Louis still. So I'm looking to continue to grow that portfolio, continue to raise capital. We got a couple investors right now. One is like a mezzanine debt fund that is looking at giving us a line of credit essentially against the equity that we currently have in our portfolio. It's a revolving line of credit that we can just spend it like a credit card, but to go buy properties. And so it's not really like a warehouse line of credit. It's unique in itself. And then we have another like an agricultural tech fund that invest in other asset classes outside of agriculture and tech. And we're looking at doing a serious capital raise with them to buy ones and twos, single families and two families here in St. Louis. And so we're about 12 weeks into the due diligence phase with that second fund, and we've done everything, checked every box. So hoping that we can go ahead and secure those funds and put them to work and make everybody a solid return.
Yeah, absolutely. So I'm just curious about that second fund. You said it was pertaining to agriculture, right?
Correct.
Yeah. So are there like certain is that only for land that's going to be used for agricultural purposes, but there happens to be a house on it, or what's kind of the difference between those two sorts of funds?
Those guys are more focused on like the future of agriculture. So they're looking at buying acres upon acres of land, and then putting a glass greenhouse over it, and then like robotics. No actual people working, but just robots on conveyor belts that kind of grow the food, um, inside the greenhouse. And so they're looking at doing, kind of interesting stuff like that. And part of their capital they treat as kind of like a venture capitalist, where they invest in some tech startups in the agriculture niche and in the agriculture industry. And I don't know everything that they do, but that's a couple of things that have come up in conversation over the last 12 weeks, and we're doing some exciting stuff. And it's crazy because I'm not going to name the fund, so that I'm not disclosing anything here. I'm still keeping privacy intact. But we were sitting at a cafe one day a few weeks back, and I sat there. We hadn't talked terms yet. They just had 5 million that they wanted to deploy, and so we didn't hadn't talked terms or anything. We were still feeling each other out, and learning what each other do and what each other's needs were, right? And so I said, hey, we haven't talked terms up until this point. I know we're not at the point or place to talk terms yet. However, do you have a ballpark yield that your investors would be searching for if you guys were to partner with us? And he said, well, right now our investors are looking hard for a 3% yield. So if we could get a 6%, they'd be head over heels happy. And up until that point, I've been giving my investors a lot more than that, and not only in debt, but also equity. And so hopefully that's a sign of good things to come. But yeah, you have to see how that plays out.
Yeah, I guess so. Only time will tell, but it sounds like you're in a good position, considering the options there, right?
Yeah. Something could come up where they just completely change their mind still. And a couple of times the guy has gone dark on me, and I had to get him back into the fold and revive his interest, so to speak. Maybe he's just doing a lot and he's busy like the rest of us. But yeah, we'll see. Maybe we'll be on the podcast later on this year and have a good look into the history and see that things went well.
That's right. Looking forward to it. So I'm just curious as well. These other potential partners, are they in the St. Louis market, or are they coming from other cities into St. Louis?
So far, it's all been here local. Friends and family really last year. Friends and family, and that was really it. I started to talk to other investors last year. So my first year in business, I wanted to start off doing, I had some single families and multifamilies going already, but I wanted to start the year off early, getting, a larger multifamily under my belt. And so I located a 16 unit and, is a C minus, C minus asset and multifamily, and about 50% occupied. Needed some work. Actually, when I called the guy, I had actually bought the list and called the guy myself, and he is 75 years old, and he was on his knees installing tile in one of the units that just turned, and he was trying to get it ready for the next tenant, and so he could start marketing it. And he goes, man, I'm so tired of this. Just come over here and make me an offer, and if it's even halfway fair, I'll probably accept it. Just a real down to earth guy. And so I get out there with my acquisition guy at the time, and sure enough, we come together on a deal, and those deals never move quickly. And so this was early January of 2020, and then the rest is history, right? So then COVID hit, and at that point I had already raised 150,000 from 3 different investors, and one of them being the seller. So the seller believed in the deal so much that he invested in the form of a seller carryback 50,000. And so he was going to put $50,000 of his profits in an escrow account for us to use for construction. And we were going to refinance him and the other 2 investors out. So we had gotten the deal, secured it, gone through due diligence, found a bank to do the loan. secure the loan essentially through a loan commitment letter, and which where we were at that point. Had $150,000 raised, and also in a creative manner, might add. And so everything looked good. And then COVID hit full blast, and so the investor I didn't have as much rapport with, who also knew it was my first large multifamily deal, got shaky legs and cold feet, and withdrew his capital. And this was about 4 weeks until we were set to close, or just under, so under a month for sure. And then so I had to tell the other investor and the seller, and so the seller wasn't able to do any more. Now, of course, I went to the seller first saying, would you be willing to do $100,000? And seller carried back and double that original 50,000. He said, no, go raise some capital. And so in the process of raising the remaining $50,000, the bank pulled the loan. They didn't pull the loan, but they changed the terms so drastically that it didn't make, it wasn't feasible anymore to use that product. And then I had to tell the investor, and then the final investor pulled his capital. And so over the course of about 3 weeks, we had a full deal, fully vetted, put together, capital had been raised, and the banking partner had been identified and secured. And it went from that to essentially nothing. And so it was just the seller and I in the middle of COVID. And he was worried that his tenants were going to pay him rent. I was worried the deal was going to fall apart because I had no other investors to go to at that point. And sure enough, it did fall apart. And that's just one of the hard lessons that we had to learn, early on, that if we would have had 16 single families in a portfolio, I probably could have taken that to my investor group that had already invested with me, and we probably could have done the deal. If we were stuck to our wheelhouse, stuck to what we knew, and stuck to what our capital backing trusted, and not try to go outside of all that just because we wanted to get bigger quicker. And that was my learning lesson there.
Yeah, it kind of sounds like you're kind of wrestling between, moving too quickly or too slowly, or right, wanting to kind of scale up correctly.
Yeah, exactly. And all the podcasts that I listen to and used to listen to and still listen to this day, I listen to a few more guys now that don't preach this as much. But you hear all the time that, go find the deal. Once you find the deal, the capital will follow. Go find a deal, and then the capital will raise itself. And there is some truth to that. If you have a platform like yourself, right? If you've established yourself as an expert in the industry like yourself, and you have a platform, you're on, Bigger Pockets and LinkedIn and Facebook, and I think you're connected on all three of those platforms. And so if you have that kind of platform, people know who you are, and you have some track record, and then you come across a great deal, you have a platform to market it on, right? And to raise capital on. And so for myself, I didn't have that. I had a handful of guys that knew me, trusted me, liked me, the people that knew what I did, from previous, firms, and that was it. And so I found the deal, and by luck, I happened to raise the capital. But then what I found was, after those guys pulled, I had no platform to fall back on, and it was just me and myself and I, and a group of investors that didn't like large multifamilies. And I realized it was important at that point to start, getting out there more and being more vocal, and which is largely why I wanted to be a guest on your show and kept following up with you to be a guest on your show. And so that it's just uber important to do that if you're really trying to make waves in this niche.
Yeah, absolutely. So, how are you, I guess, speaking of making waves, how are you looking to make waves? What are you looking for right now in the beginning of 2021?
So this year, my goals for the firm are to buy 100 doors, so about 25 a quarter. And then I estimate in order to do that, we'll need to raise right around 5 million in investor capital. And so those are my main two prerogatives right now. Of course, there's a ton of underlying things that have to take place in order for those two overarching goals to be met. Like finding the right people to run construction and growing, crew capacity to actually tackle that many doors at once. You have to have airtight systems in order to make sure that, when you close on 25 doors, that utilities go smoothly, that permits go smoothly, every single inspection phase with the municipality goes smoothly, and that ultimately you're getting a good product that's going to lease up and refinance with an appraised value that you originally underwrote. And so, luckily I have a couple people under me now that are rock stars and experts at what they do, so that we can start diverting those lower tasks to them, and they crush it and they're passionate about it, and of course we pay them well to do it. And so this year we spent the last 12 to 18 months really building the foundation, getting these first few groups of properties, sets of properties into the portfolio and stabilized. And now this year, I'm really looking for us to put our foot on the gas and really grow the portfolio. And really just make good returns for everybody, myself included. Every dollar that I make, I reinvest back into my portfolio. I haven't diversified once yet. I haven't gotten in the stock markets, and although it was tempting, when I saw all that volatility, which can also be a deterrent for some, it's tempting to get in there and bet on the winners that have shown good track records in the past and hopefully make some quick cash. But in the end, I just invested every single cent back into the firm and our portfolio and in future acquisitions, and it's going to pay off.
Yeah, there's a lot to be said for, not only having that discipline, but also enough, long-term vision to see, the end goal, and seeing, not chasing that shiny object and reinvesting, right?
Right. Oh yeah. Oh yeah. I got plenty of shiny object stories that we could with. That is for sure. And yeah, it's that, like many other skills that you really have to sharpen when you're trying to run a business. Putting your tunnel vision on and staying away from the toys and the cars and the things that money can allow you to buy. That's also work, doing the things to get to there, and then staying away from the things that will take you away from there. They're equally as tough skills to develop.
Yeah, absolutely. One thing I'm kind of amazed by is kind of your ability to organize everything, because to me, it kind of seems like you're dealing with different partners, you're having these meetings, you're raising the capital, and meanwhile, you're having to do your homework, you're doing your due diligence. How do you keep all these different pieces organized?
Time blocking. Time blocking is huge. I don't practice it as much as I preach it, and that's a goal for myself this year. But time blocking is huge, and just taking your time seriously is important. Knowing when to say no. I got friends that wanted to catch up tonight because I'm getting back in town from spending the holiday weekend with the family. And it's tempting after a 4-hour drive and packing and traveling all day to go out and just have a beer and talk real estate, like real estate guys like to do. And but what's more important to me is putting my building my brand and putting myself out there. And so just learning to not only time block, but respect your time, respect yourself, and respect your goals. And if you do that, then it makes it, I would say, easier. It definitely makes it more efficient, naturally, but by nature following those principles. But yeah, that's a big piece of it. And then just goal setting as well. So goal setting is huge. If you don't have your resolutions pinpointed by now, you need to get on it. And we're already almost into February. And so, knowing what your goals are, knowing, tomorrow, what is the most important, thing or things I need to do, and putting those at the top of your priority list, or time blocking those out first, and then just, going from there. And so time blocking is useless if you don't know what you should be spending those time blocks doing. And so, having some best practices for goal setting and creating 1, 3s, and 5s is important to get you there.
Yeah, absolutely. That was a great answer. Just kind of being able to time block and kind of see, what things take precedent, what things can wait, and just getting in there and getting it done.
Exactly. It's just you gotta roll your sleeves up. There's no other way to say. You just gotta roll your sleeves up. And some people, and myself included, will have to or had to make lifestyle changes. And for me, it was going to bed earlier, which is still a struggle sometimes. But I find myself personally, when I'm up at 5 a.m., there's really nothing you can do. You don't If you're up that early, you're not, then going to the couch and watching TV because you're like, I'm up this early, and you usually mad at yourself. So at least I'm going to make it productive, right? And so at night, I find myself, well, I worked hard today. I'm going to spend the last hour, watching TV, and before you know, it's 2 a.m. and you're watching, reruns of Cops, and like, probably should have woke up early and got that stuff done, because if so, I'd be in bed by now.
Yeah, absolutely. That can definitely be tough. Whether it's the waking up early, the going to bed early, or frankly both, right?
Yeah, exactly. And so that was the big set shift. And you know, the partners that I was, the first firm that I was a partner at, those guys were, 10 years older than me. And so they had time to not only learn best practices, but then, implement them, get away from them, right? And then come back to them because the business wasn't performing like it should have. And so, hey, now we're back to best practices and making sure that those were, like firm principles in their foundation at their firm. And so those guys were huge on time blocking, huge on goal setting, huge on KPIs, huge on following metrics. Every Friday I would sit down and look at various parts of the business, from marketing to inside sales to acquisitions and outside sales, and put together a spreadsheet. I would manually put together an Excel spreadsheet that tracked about 150 metrics. And so some of those are formula based, but a lot of those were manual input. And I would sit there for about an hour, sometimes an hour and a half, if I couldn't quite understand why the metrics were off, which was sometimes the case. And sometimes we had off weeks, or sometimes data wasn't computed correctly in our CRM. But those guys were big on time blocking, goal setting, tracking your business, tracking your key performance indicators, tracking the metrics that produce those key performance indicators, and really knowing your business like the back of your hand. Not only where you're at now and how you're doing now, but where your business is going to be here in the short term and long term future.
Yeah, absolutely. There's a lot to be said for having those KPIs, those key performance indicators. Instead of just kind of throwing everything at the wall and hoping something sticks, right?
Exactly. And I was guilty of that when I first got into real estate, and when I was first helping them build their wholesale operation, wholesale arm of their business. I was, I would say maybe even ignorant to the fact that I needed to be doing that. And so they opened my eyes to that, that revelation, and we started tracking stuff pretty closely. And then, we realized, we don't really need to track these 10 metrics because they don't really, the variances and deltas in these metrics don't really create a big swing in the business. And so maybe we don't spend the time manually tracking those, but these metrics over here might be interesting. These might drive profitability. Why don't we look at these? And so it was organic, and it changed, quarter by quarter. Definitely there were changes each quarter, and we just learned as we went. But they had some strong business principles that I wanted to adopt so I could shorten the learning curve.
Yeah, yeah, absolutely. I mean, there's that learning curve with anything, right? But it's one thing to read about, it's another thing to go in, make those mistakes, and then you build on it, right?
Exactly. I had a list of all the mistakes I made at that firm, and I kept it in my desk, and I had a list. And anytime I made a mistake, we only had 3 deals that weren't profitable, where we actually lost money on. And when you're doing 200 a year, sometimes 1 or 2 sneak in there for various reasons. And so anytime I made a mistake though, whether it was a deal that we lost money on, or why, or the reason why we didn't win a deal, and a competition got it. Anytime I thought I could have, I could have done something different, which is a mistake because I should have done it differently. Then I wrote it down, and then I try to write the lesson I learned from it. And it's a funny story because at some point, we had a heated argument, the partners and I, and they said, something along the lines of, "Are you even listening to the advice that we gave you?" And I said, "Oh, not only am I listening, I write it all down." And I, whipped the list out, and the conversation dynamic changed pretty quickly. And they were looking at it like, "This is what you learned from this? No, 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 you should have learned this." And they were telling me, what I really should have learned from those lessons. And yeah, I thought that was, just that's a memory that will always stick with me, and one of the most interesting conversations I ever have with them. And then from there, though, we thought, wow, that transparency and that really just transparency, it was so great that we thought if we applied that kind of transparency at the end of each of our partner meetings, that there might be something to be had from that. And so we did, and in various formats, and what we learned was that we did peel back layers more quickly and understand where each of us were coming from more quickly, and more from a more granular level, and really from their perspective. And so just through constructive dialogue, we were able to come up with some cool stuff.
Yeah, absolutely. It's I don't really know any of the science or psychology behind it, but there's something for, just having a thought in your mind, writing it down, and then being able to kind of reflect over it.
Yeah, exactly. Like on that deal, one of the deals we lost money on was a 4-family. We thought the perfect exit because of the neighborhood. A lot of people were doing 2 families, 2-family conversions or townhome conversions, where you got the land and the air rights, and those were going for a premium. It was a great transition neighborhood, but still going in the right direction largely. And we thought, man, this is going to be a diamond in the rough. Well, a long story short, we didn't, the layout wasn't suited just right, like these other townhome conversions were. So it really drove away. We talked to a lot of the builders. We gave our inside sales guys a list of builders in the area, and guys that are known for doing conversions, and nobody wanted it. And so we held on to it for a while, and that was one that we lost money on. But when we ended up talking about that one, and after that deal, everybody's sour about it, right? It was like, we just lost money. Like, that's real money, and that we had to write checks to the business because from our profits from previous deals, and it hurts. And then not only that, but hey, by the way, we have 8 other deals under contract right now. So immediately our attention goes to, well, okay, how can we get these out quick? How can we find the best buyer? How can we, create the biggest margin to make up for this last deal? And so we thought that being proactive in that manner was, the best use of our efforts, and it was largely for most part. But I think we should have stepped back, and we did further on down the road, and step back and said, okay, well, let's spend a little bit of time to talk about, everybody's involvement in this deal, and why we all said yes, and how we all missed it, and how we all lost money ultimately in the end. And eventually when we had that conversation, it was enlightening in many ways, and we didn't make that mistake again.
Yeah, absolutely. Sometimes it just takes, basically being honest, with yourself, and just kind of recognizing, okay, this is, where we can kind of fill in the gaps and make it right.
Exactly. Yeah, exactly.
Yeah, absolutely. Joel, well, is there anything else you haven't said thus far that you'd really just like to hammer home?
Well, I'll give my shameless plug here if we got a little bit of time. So
Yeah.
Asseto Capital is the firm, and in how you can reach me at so Best Offer Homes is our customer facing real estate firm. And so when we're going direct to sellers and acquiring via other investors and agents and so on and so forth, Best Offer Homes is the entity that we operate under, and we do a lot of marketing around that for obvious reasons. And so you can reach me at Joel at bestofferhomes.com, bestofferhomes, homes.com. And I'll give it to you, Aaron, so you can put it in the show notes. And then Asseto Capital is who we raise, who is the firm that I raise funds with for acquisitions and long-term buy and holds, and also fix and flips. We have investors that don't want fix and flips and just want, or don't want buy and holds and just want fix and flips. And so we do that as well. And so, yeah, find me on LinkedIn, Joel Gigax, JoelGigax. And from one of those three avenues, I'm sure we'll connect.
Yeah, absolutely. Well said, Joel. Well, I've learned a lot, not only about you and what you do, but also a bit about, the financial aspect, a bit about St. Louis, raising money. And it's been a pleasure having you on. Thank you so much.
Yeah, thanks, Aaron. We'll have to do this again.
Absolutely. Talk to you soon.
Thanks.